How does an economy report cooling inflation and a falling unemployment rate in the same month? And why does it still leave every trading desk on edge? In July 2026, the unemployment rate fell to 4.1%. But 264,000 people left the labor force that same month, per the BLS Employment Situation Report. They didn't find jobs, they stopped being counted. Two numbers that should tell the same story are pulling apart. The Easy Rad says the inflation fight is over. Headline CP: I eased in July on cheaper gas and groceries, Reuters reports. Except beef prices are climbing at the register while the farmers say they aren't seeing a cent of it. Call it the ghost landing, an economy that looks stable because the people who'd prove otherwise vanished from the data. So which is it? A landing or a trap wearing a landing's paint? This matters right now because every Fed decision from here reshapes who gets relief and who gets squeezed. Mortgage holders waiting on a refinance, small business owners financing inventory, and retirees living off fixed income yields all feel it. The last time the data quietly contradicted itself this way, in 2021, the Fed called it transitory. The catch-up cost 3 years. Start with the headline. U.S. inflation eased in July 2026 as gasoline and grocery prices fell, Reuters reported, welcome on its own terms. Track it against the World Bank's 5-year record. 1.8% in 2019, 1.2% in 2020, and 4.7% in 2021. Then 8% in 2022, 4.1% in 2023, and 2.95% in 2024, per the World Bank. Real progress on paper. Progress is not the same as normal. That 2024 reading sits 63% above the 2019 baseline. The pre-pandemic price level never came back, it just stopped climbing as fast, which is not quite the same as winning. For a household earning the median income, that 63% uplift compounds on every grocery run since 2019. The sticker shock never fully faded, it just slowed down. Widen the lens and the split gets starker. Gasoline and groceries are volatile categories that swing with global commodities, not monetary policy. The sticky category the Fed actually targets with rates, core services, kept climbing anyway. A rate cut cannot unbid a lease renewal already locked in for the year. Here is the catch hiding under the headline. Retail beef prices have surged through 2026 per Reuters consumer price reporting, while the cattle farmers producing it say they aren't capturing the higher margin. That is not consumers bidding prices up. That is a supply chain taking a bigger cut at every link, and no interest rate decision touches a markup sitting between the farm gate and the checkout counter. Main Street feels the same pressure from a different direction. Gyms, salons, and similar household services businesses are restructuring pricing and staffing as wage costs bite, CNN Business reports. Wages did not fall. The cost floor under services just got permanently higher, and headline CP: I can ease for a year straight without moving it. So if wages and services costs keep climbing while the top-line number cools, is the inflation fight actually over, or just entering a quieter, more dangerous phase? Hold that question. The labor numbers make it worse before they make it clearer. Wall Street strategists called the July report a pretty horrendous report, per Bloomberg's market reaction coverage. The reaction landed before most viewers had even parsed the headline number. Look at the mechanism, and it reads differently. Here's where the two problems link. As wage costs push services prices higher, employers cut hours or hiring in those same sectors, exactly what discouraged the 264,000 workers who left the labor force in July. The BLS Employment Situation Report for July 2026 shows the drop came almost entirely from 264,000 people exiting the labor force, not from new hiring. That is the ghost landing again, at street level, a rate that falls because the denominator shrank, not because the numerator improved. Nobody rings a bell when a labor force quietly empties. Zoom out, and the World Bank's 2025 estimate puts unemployment at 4.2%, consistent with a market that looks calm on a chart and weaker underneath it. A 4.1% unemployment rate still sounds like full employment by any historical standard, which is exactly why rate cut odds repriced within the hour of that release. Traders read the mechanism even when headlines didn't. There is a precedent for this exact shape of number. Japan's lost decades hit a generation of underemployment and discouraged workers behind official rates that looked, for years, almost respectable. The mechanism in July 2026 is the same shape. It is just moving faster. Compare that to the pre-pandemic pattern, when unemployment fell because payrolls added workers, not because discouraged workers gave up looking. The shape has flipped. The Fed's mandate is two numbers: stable prices, maximum employment. July delivered a headline that appears to satisfy both, while the internals violate the spirit of each. And the gains that did happen were never shared evenly. The top 10% held 30.7% of US income in 2024, and GDP still grew 2.16% in 2025 to reach $30.77 trillion per capita GDP, near $90,027, all per World Bank data. The top line looks fine. It always does, until someone checks who's actually inside it. A tight labor market that doesn't move the income share was never as tight as advertised. So, is the labor market healing, or hiding a problem no rate cut fixes? A shrinking labor force is not full employment. It's arithmetic wearing a good outfit. There is a number that ties the Fed's hands regardless of which story you believe, and it has nothing to do with jobs or prices. That's mixed. The number that boxes in every rate decision isn't a percentage, it's a bill. The US Treasury is now paying roughly $3 billion a day in interest on the national debt, according to the Congressional Budget Office's monthly budget review for July 2026, which tracks net interest outlays in real time. Annualized, that's over $1 trillion, roughly comparable, by way of illustration, to the entire annual GDP of a country like Switzerland or Poland, spent purely on interest before a single dollar touches principal. Debt to GDP stood at 115.8% in 2024 per World Bank figures, up from 100.2% in 2019, a rise of 15.6 percentage points in 5 years, or roughly a 15.6% relative increase. Set that against peers using approximate IMF and World Bank estimates. Japan carries roughly 255%, the UK around 101%, Germany near 63%, France about 11-12%, and Canada close to 107%. The US isn't the world's most indebted economy. It is, however, approaching the debt load the US carried at the peak of financing World War II, when estimates put the ratio near 11.8 to 121% of GDP, slightly higher than today's 115.8%, but close enough that the comparison still holds. Read that last part twice. Nobody plans a recovery around beating a wartime debt load in peacetime. The last time the Fed faced sticky services inflation next to a cracking labor market, it was 1979. Paul Volcker pushed the federal funds rate above 19% to break inflation expectations, at the cost of 2 recessions back-to-back. Nobody is proposing that cure today, for good reason. Picture a household covering one credit card's minimum payment by opening a second card. That isn't paying debt down, it's postponing the math one billing cycle at a time. Analysts tracking Treasury issuance patterns estimate current federal financing strategy has left roughly a $1.45 trillion shortfall funding a $2 trillion deficit, per Financial Times analysis of issuance data. One interpretation of the data among several, not a settled conclusion. That gap doesn't vanish. It gets refinanced at whatever rate the market and the Fed sets next. Which is exactly the trap the two narratives create together. Cut rates to relieve a shedding labor force and the $1.45 trillion shortfall refinances cheaper, but so does the incentive letting services prices and beef markups keep climbing. Hold rates to finish the inflation fight and the interest bill keeps compounding near $3 billion a day, while a labor force already emptying keeps emptying. There is no lever here that isn't also a cost. The debt service bill compounds faster than an economy losing workers to pay it, tying the sticky services prices from round 1 and the shrinking labor force from round 2 into the same bill. Layer in looming Canadian tariffs of up to 50% on cross-border supply chains, per Wall Street Journal coverage, and a fresh cost shock arrives exactly when the Fed has no clean lever left to pull. Follow that all the way out, and the picture turns bleak fast. A labor force still quietly emptying. A debt service bill compounding faster than the economy funding it. Supply chain markups, nobody with pricing power plans to give back voluntarily. Rising costs are already pushing some households to give up pets they can no longer afford to keep CNN business reports, and even rehoming them now costs more. That is discretionary spending failing at the kitchen table level, while the headline chart says things are cooling. That is not a soft landing. That is not a spiral either. It's a standoff. 3 trapdoors, one central bank standing on all of them at once. It would be easy to end the episode there and call the decade lost before it starts. But the Fed has navigated this exact shape of problem before, and not by luck. Under Alan Greenspan in the 1990s, the Fed guided a productivity-driven disinflation from over 5% down toward 3% across nearly 3 years without triggering a recession, holding real rates positive the entire time. Proof of landing this narrow is difficult, not mythical. Canada ran its own version in the same decade, cutting debt to GDP from roughly 100% to under 70% within 10 years through steady fiscal restraint rather than a shock adjustment. Germany's Kurzarbeit short-time work scheme kept its unemployment rate from spiking during the 2008 crisis by subsidizing hours instead of severing jobs outright. The same targeted logic proven at scale. Targeted labor market support, wage subsidies aimed squarely at services hiring instead of blanket economy-wide rate moves, has historically closed participation gaps like July's without reigniting the price pressure a broad cut would. So which story is true? Soft landing or wage price trap? Both, and that's the uncomfortable answer. Headline inflation cooling and unemployment falling are real numbers. So is a labor force still shrinking by hundreds of thousands a month and services prices still climbing on wage costs that have to land somewhere? The $1.45 trillion financing gap doesn't disappear into some account. It gets paid eventually, by savers holding dollars losing purchasing power to the next round of issuance, or by workers who lose a job when a rate lever finally gets pulled too hard in one direction. That credit card math doesn't forgive itself just because rates fall. One plausible scenario, floated by some market strategists, the Fed holds longer than markets are currently pricing, on the theory that premature cuts punish the debt service math faster and more visibly than patience does, though other analysts expect earlier cuts, and this is speculative commentary, not investment guidance or a forecast to act on. Watch the labor force participation rate before you watch the unemployment rate. That's where July's real signal was hiding, and it's where the next one will hide too. None of that requires panic. The Fed cuts and risks a new round of services sector wage spirals. It holds and watches the debt service bill compound while workers give up looking. There is no outcome where all three problems, sticky inflation, a shrinking labor force, and compounding debt costs, resolve together. That's the real story of July. That question from the top, an economy reporting cooler prices and a shrinking workforce and calling both good news, has an answer now. It can, for a while. The ghost landing isn't a landing. It's a plane still descending, engines throttled back, runway not yet confirmed, watch the labor force participation rate, because that's where the next signal hides. Thanks for watching, mind your reserves. This video is for educational purposes only and is not financial advice.